Mobile Home Park Investing. Welcome, Glenn. It's a pleasure to have you on today. Why don't you give us a little bit of your background and your career path to mobile home park investing and brokering?
Sure. Well, Anton, thanks for having me on here. I really appreciate it. I'm glad to speak to you and your audience. And as you had mentioned, I'm a broker, but I've been doing this about 20 years. And I'm a former park owner. I no longer invest in manufactured housing, but I used to own a park and used to be in that world. Now I don't like to compete with my clients, so I provide a stronger advisory approach where my clients don't have to compete with me on deals, because to me that would be aggravating if I was a buyer or a seller for that matter. So I've been selling parks for a long time. I sell hundreds and hundreds of parks. I typically sell 1 to 3 parks a week. We've sold, over $100 million worth of parks this year alone. We typically sell parks that are in that $2 to $5 million range. Sometimes they're as small as, $250,000. Sometimes they're as big as $40, $50 million. And we have a lot of different types of deals, a shoe for every foot, if you will. But we really bring an advisory approach. And within the advisory approach that we bring to the table is, we bring an advocate approach to affordable housing, because, I'm a strong believer in affordable housing just being a necessity for our country, period. There's not supposed to be an exception to that, and yet there's become a lot of exceptions to that. And my industry is really the bottom level of affordability. It doesn't get much cheaper than our industry, and yet we still have homeless people out there, and we still have these kind of rigorous guidelines that were based on maximizing profitability in a park through the easy type of stuff instead of the hard work stuff that has a longer lasting, more impactful type of an account for our community and for our culture in whole. That all said, at the end of the day, I'm a broker, and I broker a lot of deals. I have a national team, East Coast to West Coast, border to border, and we hustle. We hustle a lot. We evaluate, easily over $1 billion worth of parks a year. We transact on a couple $100 million of parks a year, and we sit here and build relationships and kind of teach some best practices. Explain to current owners how to optimize their P&Ls, to be able to get to the best values. We help buyers understand that this is an industry that's not meant to sit here and squeeze and get all the profits out of it, because you're actually, hurting your food chain when you do that. That's where we differ a lot from a lot of the other brokerage shops that are out there. And there's some excellent, some of my competitors are excellent and have the highest of respect for them, but they just go about it at a different approach than I do, and the way that I teach my team how to do it. So that's kind of how we've carved our little niche into this scene. I've been through recessions with these parks. I know how painful this stuff can get, and through this most recent time, it's been interesting to see just how insulated our industry is. Very similar to how insulated we were during the Great Recession years and years ago. So that's kind of me in a nutshell. I wrote a book. It's kind of the easiest thing in the world to read, and you kind of get some best practices out of it that's actually actionable. There's no upselling in the book. If you don't like it, write me a letter and I'll give you your money back. But we've sold thousands and thousands of copies now, and it seems to be something that was well received. We farm information, day in and day out. We have 50,000 parks, 20,000 plus owners, and we have down to the nitty gritty details on 10,000, 15,000 parks. And we really focus on the data, teaching us what the future is kind of going to look like on a transaction and how to most optimize a transaction, whether you're a seller or whether you're a buyer.
Yeah, very good. Thanks for that intro. I would say a book like that is really crucial, right, for investors to have access to. As many of you know, right, we are very active on the financing side for multifamily properties, for all commercial real estate, but it's only a lot of multifamily properties. We also have a lot of clients that invest in workforce housing, like the typical C-class multifamily property. And they naturally also have an interest in mobile home parks. They want to know what is the difference, right? What are the risks? What are the benefits? And I think writing a book like this and for them having an access to that type of information is really very valuable, right?
It's strange to think this industry that everybody all of a sudden really loves, the last, significant books that have been written on this are, 15, 20 years old. And, I've been doing this so long, I just sat down and said, well, I'll just put my thoughts out there. You can go to a course and pay a few $1,000s, and get some upselling in there, and you buy another course and another course and stuff like that. And for the average Joe that's, only got a couple $100,000 in their pocket, and they're trying to maximize that and get into something, my book, fulfills that essentially for you. It's just step by step all the way through. It's the good, bad, and the ugly. I don't hold back. It's filled with deal stories of people who failed in this business that I've transacted with, and filled with deal stories of people who are, wildly successful that I've transacted with, and kind of the broker's opinion on the whole, how it could have gone one way or another way. And this is, sort of the best practices that I've seen. And it's, like I said, it's been received well. I do not accredit myself as being any kind of real smart guy who knows how to write a book. Okay. So, I'm speaking to hopefully, the widest possible spectrum of people that they got some extra money. They're looking where to place it. They're looking at our industry being told, oh, hey, it's easy peasy. And I'm here to tell you it's not easy peasy. It's hard as hell. Unless I guess maybe the super smart guys make it easy. I don't know. But for a guy like me, it was a very hard business. And, I nearly lost everything when I invested first into this and managed to turn it around. And nowadays, the market's so good. Everybody's thinking they're so great at what they're doing. But, times change and things change. And you go from, hey, I'm feeling great and got all this great, easy money from other people's money. And I'm making all this, this crazy returns. And then all of a sudden you're on this weird slippery slope and you're sitting there going like, oh my gosh, what am I going to do now? And, this book, in my opinion, was to help with guys like that, because there's so much overselling people do in our industry, especially the GPs to the LPs, telling everybody how great this industry is. And half these GPs are newbies and they don't know it. They haven't been through a full cycle yet. And it's kind of, bringing some light onto that with understand this business is not easy. It's in fact really hard, and way too many people think it's easy, and then they come crying to me a couple, months or years after the acquisition saying, help, get me out, or help me turn this thing around. What do I do? And, that's what I'm hoping to help people avoid,
Yeah. Very good point. We see that also on the traditional multifamily side, right? There has been a massive influx of new GPs, syndicators, right, that come from different industries. They do not really have any alternative asset management experience, acquisition experience, but they go through all the training classes, right, with all the coaches that are out there, and they jump in, and because they are able to raise all the equity from all the passive investors, they now turn into GPs. Yep. And we only see there in that segment also quite a difference between the good ones that really spend time and effort and also build their systems, and the ones that still try to do it kind of on the side, treat it as a side business. And those were successful in the past because the market helped them so much, right? Everything moved up. But we only have seen over the last year or so the difference between the good operators and the not so good operators. So it's good.
Fissures. We're starting to see some fissures happening. And for my industry, it's the difference is, it's an easy upsell. Hey, I'll pay you 20% IRR, and we'll make 3x on our money in a 5-year span, right? Well, most of these guys are not, they're not doing anything more than optimizing a P&L and squeezing the revenues on the poorest of the poor, so they can justify this cockamamie 20% IRR stuff they're trying to achieve for these LPs that they oversold them on. And it puts this negative downward pressure on the tenants who can barely afford a $50 anything, much less a $50 a month increase in their rents. And the justification is, well, they're still below market, or hey, this is way below market, and there's still a lot of value here. And I really get almost a little offended on it. And I understand I'm a capitalist through and through, but at the same time, as I claim to be an advocate of affordable housing, when you come through and put these kind of pressures on your tenants, and you're still sitting on vacant units or vacant lots or vacant homes or vacant whatever, and you haven't applied for expansions, and you're just growing your revenues by increasing rents but not increasing occupancy, you're going to have, you might have some happy LPs for a minute, but you're going to run out of lifeline on squeezing that stuff, and you bring in more regulation to our industry, whether you know it or not, because every time that happens, somebody's getting pissed off, somebody's writing a letter, and eventually, the municipality is going to crack down on you, the state government might crack down on you, or as in the case of New York, they might just throw a whole new, broad sweeping rule about, hey, now you're stuck with this 3%, rent growth maximized, or in California where they got vacancy control and stuff like that. We do that for ourselves. That's our own fault when that happens. That's not the congressman people. That's our fault, because we got too aggressive in our approach to selling to the LPs about the kind of returns we can do them, because we didn't actually have a real education getting into this business a lot of times. And we just said, hey, I know a few people who've got some money, and they'll give me that money, and I can make my carve out, and I'll just jack it up on these other people. Well, this is not industrial. This is not retail. This is not Class A apartments. This is people that struggle to live with $500-600 a month sometimes, and that's painful. Just because you can't do something doesn't mean you should do something. Kind of stuff comes into play with this, and that's kind of how we look at it. So, we really teach the approach of, hey, there's all these other avenues to increase solid, sticky revenue into your streams that you need to maximize first before you go beyond a 3 or 5% rent increase. And yeah, some states have, the warning signs of rent control coming in, and you might be in a race to try and get your rents up to market before that happens. And yeah, I understand. Yes, there's always caveats to what I say. I mean, literally, there's always caveats to everything we do in this business. But, in general, the general practice of, hey, here's rents that are $200 below market, and I have 50% vacancy. It sounds like a home run. But at the same time, if you're the guy that reaches for the quickest, easiest thing, you're probably taking those rents up before you're filling up those vacant lots, even though those vacant lots are worth a hell of a lot more once they're filled than your rent increase, because you can't keep raising rents. It's just it's unsustainable. You're going to have maybe 3% is sustainable to keep up, a little bit above inflation and keep up a little extra. But when we start seeing operators come in and jack up rents, $150, on a rent that was already only $150 just because the market can support $350, but you didn't increase your occupancy, it's going to bring regulation. And that's, man, we don't want regulation. Let's regulate ourselves. Let's be the good stewards of our parks and our tenants. Let's build communities. Let's let the poorest of the poor know that they have a safe place to always live, that they're not going to get priced out, just like we've done with so much of the inner city stuff in all of our, big urban populations. It's our own fault, and we're here at this bottom baseline to provide a safety net. And if we keep pressing, we're going to affect change, and it might not be the kind of change that we were hoping to affect. Legislation is a bear to deal with when it comes down. And, financing is a big part of this factor. If the banks would open up a little bit more to our industry and understand that, hey, just credit scoring, everything, income levels aren't everything, looking more at the trajectory of a tenant's ability to pay, especially in affordable housing, and how the banks are going to loan on those tenants in place, help them get a good house, or help a park owner buy it at an affordable way that doesn't force the hand in the rent increase right out the gate, is all part of the factors, and thankfully Fannie Mae and Freddie Mac have really opened up this year with us and given us a lot more, ability to transact than ever before. So kudos to them for making life a little bit easier for everybody right now in this industry.
Yeah, that's definitely helpful that they stepped up there, right? Obviously, they want to see reasonable quality assets, right, that are also well maintained, which all makes sense, right? I think you also brought up a good point of a lot of operators, they want to go the easy path. Let's move in, let's raise rents. but they do not really look at the operations. How can you improve your NOI by actually reducing your expenses, right? Make capital expenditures that ultimately improve your operational costs too, and just run it properly.
A lot of guys, they say, hey, I'm going to improve this, I'm going to do this, fixing this P&L stuff. And then they essentially just build back extra revenue, and they call it not a rent increase. I'm just building back some extra revenue. Yeah, that made your efficiencies look better, but your actual critical stuff, your R&M, did you argue with your tax people? Did you get the best possible insurance? Did you get this? Did you get that? Not just did you build back the water? Hey, I get it, build back the water. But at the same time, that's not really the type of improvements that I believe you're discussing and that I'm referring to either. There's, your R&M, you got to get a handle on that stuff. It's like sometimes it's bananas how little the former operator is spending and how much, the next guy might spend, and they're still way out of whack. You got to find that nice, healthy number. Did you get the best landscaping contract that you could? Did you get the best snow removal contract that you could? Do you have all these other vendors available that how to maximize the efficiency of your P&L, especially if you're an out-of-state hands-off type operator, or owner, should I say? If you're one of those hands-on operators which is a lot of the mom and pops and the first-timer investors are in there, I applaud you guys, getting in there and doing the dirty work. That's what I had to do. I used to crawl into trailers day in and day out fixing stuff. And please, I never want to do that again. But there is something you learn about operating your own business when you're doing it that way. And most of these syndicator types, they're not getting the hang of it. And then they're paying through the nose because they don't understand, they don't have the right vendor listing essentially in place. And they don't really know what needs to get fixed, and then the LPs yell at them about, hey, you're overspending on this stuff. And then they say, oh, it's okay, we're going to adjust. Here's another $10 rent increase, and it's like all of this feeds into it together. And when you can optimize your P&Ls, that's just best for everybody. But optimizing a P&L does not mean, adding extra revenue to the equation to offset the optimization on the P&L. In my opinion, as a park owner, and I get it, I'm not the best, the best of anything in this operating class. I probably did it all wrong when I was an operator. But my thing was, well, fix everything first, get everything done first. Before you go and raise anybody's rent, because who are you to raise this guy's rent? You just bought the park. You don't know. All you're doing is hurting his feelings. He didn't see that you were going to improve the roads. He didn't see that you were going to improve the water system. He doesn't see that you're going to do all these things later on. And you're going to mask it. Well, hey, I need to be able to afford to go do this for your park, so I'm going to raise the rents now. I say, take the reverse. The money all works out to the same over a 5 and 10 year run. Do it in reverse. Make your LPs take a little bit of a pause on the first few months of receivables, when you're getting all this initial CapEx done. Work through things that way, because in the long run, it's going to build better tenants for you. They're going to trust you more, and it's going to help your bottom line because they're going to pay their rent more often, and they're going to know that, hey, this is a guy who's actually, putting in the work to give me a safer environment. And that goes a long way with this level of tenant class that we have. Maybe not in Class A stuff, I don't know, but in the lower end of stuff, as a person who was, had significant housing issues when I was, living my life and always kind of being worried about, rent increases. As I became more successful and more in tune with this policy that I have of how I look at these parks, I see it as a win-win-win for everybody, the LPs, the tenants, the operators, because it's a little extra money up front, and it's a little extra long on the timelines. But at the end of the day, by the time you're turning over your 7-year fund, it's all balanced out. You've made better money. You got better tenants, stickier tenants. You got a better looking park. You got a better reputation. The county is probably willing to give you an expansion at this point, and it feeds itself that way. If you do it the other way, well, you're always kind of chasing your tail and justifying what you're doing. Because, what if you didn't have it in the budget even after the increase to do this repair because a different repair came up, and then when you're going to charge, another rent revenue, another rent bump again next time, but now you're going to double that rent bump because of this, you see how it could feed itself negatively that way.
Sure.
But again, plenty of guys have proved me wrong, and they're real nice guys and they make a lot of money and they have some hell of a parks. It's just not necessarily how I think moving forward in the future of our business. is the best approach. If
Yeah.
the money all washes out at the end, I bring this other theory into here, what we've kind of coined as being an empathetic capitalist, okay, which is bringing a sense of empathy to our industry, because we are dealing with the poorest of the poor. It's not like you're dealing with some corporate guaranteed lease at an industrial building, or some tenants who are making $200,000 a year but living in a high class A apartment in a downtown suburban area, or urban area. Oftentimes we're dealing with people that have been removed from society so many times that you have to know your client, first and foremost in this industry, is know who you're affecting, because that's important.
Yeah, it's a good point, right? We see that also in the C-class multifamily space in particular, right? The operators that really take care of their tenants in the best possible fashion, they get the better quality tenants that are also loyal to them, right? And obviously everyone is in this business ultimately to make money, but if you are just squeezing every cent out without providing value, short term you may be able to raise rents, but the quality of your tenants goes down, right? So from an income perspective, they definitely cannot afford the higher rents. And the better quality tenants that potentially can afford it, they don't want to live in that property because the quality isn't there yet, right? So that's a very important point. If you want higher rents, provide more value and the better quality, and you can attract better tenants that are able to afford a little bit more.
Yeah,
it's a good point.
Yeah, and being that we're different than apartments, with apartments, you're kind of fixed on this one block of building and X amount of units and X amount of ways you can maximize that thing. With manufactured housing, it's not as fixed, and the tenants, they're either there because they got no other options, or they made a very conscious option and decided to move into a park and just own their own home and pay a very minimal amount of lot rent and live that, like a lot of fixed income retiree community type of stuff. A very deliberate choice to live there. But a lot of these other parks that are B, C, D type of quality parks, oftentimes it's not a deliberate choice. It's a, damn, I got no other option choice. And, this is where I have to go because this is about what I can afford. And, at the end of the day, if you're just trying to achieve a particular return, that return's achievable. It's not necessarily just by squeezing rents. It's like they used to say when we were younger, there's 1,000 ways to skin a cat. Well, it's no different here. If the point is to get from A to B, we can show you how to get there. It might not be the straightest line, but it might make you actually sleep better at night, give you a more sticky base, and you're still going to make the revenues. You're still going to make your cash flow. You're still going to have an unbelievable exit when you've maximized everything under this way. And that exit's going to offset any additional capital that you had to put in the beginning, any length of time in that contract, in my opinion. And when you optimize that way, just to me, it's a win-win-win for everybody.
Very good. So let's turn a little bit to the market environment, right? You touched on
Sure.
very briefly before. Obviously, we have had a number of very good years, right? And in 2020 started extremely strong, and then we had COVID-19 hitting us, particularly in March when the bottom fell out in the markets and everyone was scared like crazy. Certainly on the multifamily side, they have performed much better than expected. So it would be interesting to hear what you have experienced on the mobile home park side.
Yeah, our industry is hands down the most resilient industry in the real estate vertical. Okay, of all the verticals, manufactured housing, it's as resilient as it gets because we're the bottom safety net, right? It doesn't get any cheaper and more affordable. And now with social distancing, it only even makes more sense. Okay, so we went into 2020 as if 2019 was the best year we've ever seen. Okay, as we said about 2018, as we said about 2017. Okay, and we've had a real nice run from about 2012, 2013. Through here, and we started at 10 and 12 caps, And that cap has compressed and compressed and compressed, where now we're like looking at, 3.5, 4 caps on a day one type of number, saying, yeah, no, it's a good deal. It's a completely different dynamic. And that's somewhat due to the new financing that's available out there. And of course, that's not every deal everywhere, but we just closed the deal in Little Rock, Arkansas, which, hey, it's a great market, but maybe a market nobody's ever heard of before. And we sold that on day one number at a 4.05 cap. Okay. But what makes our cap rates different than apartment cap rates is we have a lot of up left in our cap rates once you go through the acquisition. Whereas, you buy a single tenant lease, you're probably more or less going to ride pretty flat with little, a couple bips here, a couple bips there. But with MH, it's, where you start today is not going to be where you end up tomorrow, and you're going to get the recompress at the end. So transactional volume for me this year, so far, where we are in this year, we've done, I don't know, I guess I've sold maybe 20, 21, 22, 23 transactions this year. I don't know how many parks that makes up all on each of those transactions, but a bunch. And, just over 100 something $100 million worth of value in parks. We have about 150 million or so more under contract that is, ideally going to close before, the end of the year. But, December is sometimes it pushes over to January. But for me, it's a banner year. But last year was a banner year. The year before was a banner year. And we're not seeing that in its sight. Going back to the recession, the 2008 to 2010, kind of like, what's happening here? We're one of the only industries that was increasing occupancy and increasing rents. Now, during this cycle, we haven't seen a lot of rent increases. At the cycle, we've seen tremendous rent increases. But during this COVID portion, we've actually seen landlords lay off on a lot of the rent press because they were like, hey, we were going to do a rent press. It was supposed to come out in April or May or June. But with how things are, we don't really need it, and we'll just keep maximizing some of the vacancy that's here. Because right now, good luck trying to find some vacancy in any primary market in manufactured housing. Even in the market that I live in right here, in Wilmington, a small town, 100,000 people, there's almost no vacancy, period, in manufactured housing. But yet in apartments, you got a solid 10 or 12% vacancy kind of running about. But in manufactured housing, you just cannot find a vacant ground. And that's kind of true in the secondary cities across the board right now. And that's nice to see that occupancy has maintained or increased while rents have stabilized not so much. But this last couple months or two, now that everybody's kind of adjusting to this new normal, and we know we have another big winter to get through, and it could be a hard winter, it could be an easy winter. I'm not a crystal ball, but now we're starting to see people starting to push rents again, but not as aggressively as maybe they did last year. So our delta for rent collection, or our rent collections right now, are more or less on par with pre-COVID levels. There's virtually no delta there, whereas many of the other industries are close, but maybe a little bit south of where they were 12 months ago. And as you change different verticals, it might drop dramatically. But MH during the Great Recession and during this COVID period, smooth sailing so far. We're seeing more transactions. We're seeing higher pricing. We're seeing more velocity, and that's boding really well for our industry. And it continues to make us all feel real special because hey, sometimes we haven't been the most special vertical. Going back 5 years ago, I'd have to argue with everybody about, hey, no, 10 cap's a really good deal. You should look at this thing at a 10 cap. And nowadays, we're talking about, hey, no, this is a 5 cap. It's a real good deal. And it's a lot easier to sell today than it was 5 years ago, even when there was twice the amount of yield on it. But the supply and the demand is a big factor in ours. There's only 50,000 parks, of which only 20,000 are even anything close to considered, investment grade. And of that, anything close is really only about 10, 15,000 parks that actually kind of are investment grade. And of that, there's only, this industry is consolidated a lot. There's at least, I'm tracking at least 370 something people that own at least 600 units, or at least 6 parks. And that's That's not where these numbers looked like a few years ago. So the supply demand curve is really wacky right now with, high intensity demand for our industry and low supply. But more supply than we normally see. With the amount of transactions we're doing, like I said, we're doing 1, 2, 3 deals a week. And in December, I got probably 8 closings on the books. In October, I think I had 5 or 6 closings on the books. And in November, we're looking again, somewhere, 6, 7, 8 closings on the book. So we're seeing more transactions, but the supply has not been met yet, or the demand for the supply, is still, very much in the seller's favor, which keeps us pressing heavier on purchase pricing. But I think at some point it's going to start to moderate. I just don't think it's anytime soon. As long as the banks keep their debt, as low as it is, sometimes 2.5%, we're going to adjust our pricing to be a factor of the interest rate compared to the cap rate, just having enough spread, because we know, 3%, if you have a 3-point spread, you're probably getting to 20% IRR. And, right now it's not 20% IRR stuff. Right now it's more like 15% IRR stuff. And, so on a 10-year levered IRR, it's probably closer to a 2-point spread on most deals, and that's kind of how most brokers, I would assume, are pricing their parks as well, because that's kind of how we're doing it, and seeing, that there's still appetite there, and kind of helps us keep pushing this momentum. There's a big push in our industry this last 2-3 years to consolidate, a real big push. Hundreds and hundreds of millions of dollars come in with every other person I can talk to. It seems like they got a fund for $200 million, half $1 billion, a bunch of $1 billion funds out there right now. And the consolidation, I think, is the real key for, where this industry is going. I don't know if it's a good thing or a bad thing per se, but I do see it as a big factor in what people are doing. And they're buying as many parks, packaging them, producing something out of them, taking them up from X to Y, and then selling it to the next guy who would sell it from Y to Z. And kind of that package upgrade has been happening. There's been some fantastically large sales that have happened, $1 billion plus deals that have been happening this year as portfolios are being rearranged. And that's crazy stuff, man. That's not curve early on, got in there and is doing it, and his program is being replicated throughout and over again. And it's pretty impressive. Like I said, I don't know if it's for the good or for the bad, but it's impressive nonetheless. And we continue to see, skyrocketing growth of this industry.
Yeah. Okay. So that's it's a massive amount of funds that's only coming into that segment, as well as multifamily, right? They're just the darlings right now when it comes to commercial real estate.
Yeah.
So where would you say that right now the more the institutional type of investors, like these 100 million, 200 million plus funds, what are they looking for in terms of minimum size and quality?
All over the place. All over the place. There's some groups that won't touch anything that isn't 55 plus and 200 spaces. Some groups that are like, hey, I need 400 spaces minimum. Man, there ain't a whole lot of those left in the country.
Right.
Most of those ain't gonna sell again, until you have a big enough package to buy all of them from that guy. But there's a couple groups that I've sold thousands of units to just this year and some last year, where they have substantial funds, and they're chasing more of the value add right now. They're doing that non-institutional grade type of park, but with enough capacity put in place, they could probably sell it as a bolt-on portfolio to another operator that has a more traditional institutional portfolio in play. So like most of the traditional institutions that are in here, and some of them aren't genuine institutions like you guys might call in apartments or in industrial. But in our industry, we call them institutions. They're big players. Some are public companies, some are not. Some are Wall Street guys, and some are not. Some are just mom and pops who just got real good at the business and they own 100 parks now. But a lot of those guys traditionally are really only looking for 100, 150 units and up, mostly, stabilized so they can get some Fannie Mae debt in there. Wow. And, those deals are so hard to find right now. You know, they exist, but they're so hard to find that they're not having as much luck, and they're looking further down the pipeline than they used to, and saying, well, maybe we do 75 spaces and up. You know, if it's somewhere near one of our other places, maybe not necessarily a bolt on, but we can have some efficiencies in our operations if it's, not too far away from something else. And then there's the guys, like I said originally, that are looking at just straight up bolt-on packages where we're helping them consolidate a lot of that industry. You know, there's a group that I work with, all the time. I love these guys to death. They've been nothing but excellent to work with. And, they've bought probably about 800 units this year, which maybe isn't their best year, but things are getting expensive. But what they're buying fits so well for the next guy in the food chain that they're going to make a record sale on this stuff, because value add, as the cycle gets deeper and deeper, is becoming more and more expensive. The value on the value add is priced heavier now than it's ever been before. 5 years ago, if you had a vacant lot, too bad for you. If you had a park-owned home, too bad for you. Nowadays, we got new models in place that value those park-owned homes aggressively and value those vacant lots aggressively. Granted, not as aggressive as the day one cash flow stuff, but there's still new values that are being applied to there that used to not be there.
Yeah. So what would you recommend for someone who wants to enter now? Obviously, it's a very competitive environment, right? What should they focus on in terms of size and or market where you feel, look, if you come to me and you say I want to compete for a particular deal that you're listing, what do they need to bring to you and the seller that they even have a chance to win that deal as a newcomer?
It's hard, and I know it's going to come as sounding like a biased piece of advice because I'm a broker, word, right? But pay the piper, man. If you got a shot at buying a good deal right now, and the only thing that's keeping you from winning is that you're not as reputable as the other guy because you just don't have a track record, put up or shut up. Get your money in there. Get that guy to talk to you based off of, hey, I can do this job well, and I'm willing to pay you well to do it. Now, don't drop the ball once the owner says okay, but sure. That's where the new guys are winning. The groups that I just mentioned that I built a couple thousand units with, they were the new guy a couple of years ago, okay? 3-4 years ago, they had 0 lots. Today, they got 4,000 or 5,000 lots, and it comes at a cost. It just does, it comes at a cost. If you're trying to syndicate deals, your LPs are beating you up on price already. So we already know for the first year or two as a syndicator, you're not making anything anyways. So you might as well pony up and get the good deal done, okay? Get the right deal, because your waterfall at the end is going to pay off dividends for you. And it's now, not, the only time better than now is yesterday. And we're not going to see another time like yesterday, I don't think, anytime soon. So you're either going to miss the boat and consolidation is going to be complete. And if you think it's hard to win a deal now, it's probably only going to be 10 times harder later on. And if you have the money to pay up, because I think this is a disappearing inventory. They're not giving us new zoning. We have virtually no new developments, caveats excluded. I know plenty of people have developed a park here and a park there. Took them 5 to 7 years in some cases to get the approvals, but we have pretty much no new development. And the rate of decline of parks by takeover from a municipality because of a setback rule, or the guy couldn't perform on something, they shut these things down. Now we're probably trending at losing parks more each year than we are building parks, and we don't see that changing because nobody wants a trailer park in their backyard, as they say. So if you like our asset class, get the time machine and go buy it 20 years ago, or pay the piper today, because I don't know how to get a good deal for anybody anymore, because they just don't exist. And there's plenty of brokers that will totally lowball a seller for you. I'm just not one of them, and that's just not going to happen with anybody on my team. We're here to help our owners who put their legacy into this thing and have all this sweat in there to get paid, and sure. The new guy coming in, guys, even if you're paying market price, it's not a bad word. It's not a bad word. Your LPs are going to appreciate it later down the line, especially if you set expectations with them up front.
Yeah. It's a good point, right? Setting expectations is really crucial, right? Obviously, they all have the same challenge, right? The passives expect cash on cash return in year one, right? Even though it may not be realistic, right? So they have to come up with their pro formas that somehow are able to come up with to show cash on cash, even though it might not be realistic. So I think that's a very good point. Just come up with a pro forma that actually makes sense and sell it to your investors as what it is rather than overselling it, right? And that brings me back to what you said initially. Don't think that you can come in, raise rents without really improving anything, because you need to do it based on your pro forma, and then everything blows up because you lose the tenants, right? Or you get the bad tenants in, and ultimately your cash flow is actually suffering, right?
Yeah,
So,
it's, because you're monetized to kind of jeopardize yourself almost with the way these structures are set up when you do it that way. And as a syndicator, you guys got a real hard gig for, especially for a new guy. I mean, like, you're getting squeezed. You're getting squeezed by me. You're getting squeezed by your LPs, and you're probably not making anything. You probably wrote in, hey, I can totally make a 5 to 7% management fee on this thing, is what makes sense on paper, right? Until the push comes to shove and you realize, this is going to be a loss leader for you as you get to 1,000 units. And that's really what you need, at least, for most guys, is at least 1,000 units before you even start breaking the level on your efficiencies and start actually being able to be like, hey, I got a job now, beyond just having a thing that drives, bullet wounds into my head all day, because that's kind of what it feels like for a lot of these syndicators out there, is they just get hammered from all sides. But it goes back to the original setting the expectations. And when you have a high supply, or you have a low supply and a high demand, I mean, that's just good economics anywhere. And you got to understand that this is the kind of thing that it might not always be this way, but for the foreseeable future, it's probably going to be this way. And, if you're trying to make a buck in this industry, you're not going to make it overnight. And the guys that do make it overnight, I generally don't have a lot of, pride for them, because they probably did it on the backs of all the poor tenants. And that sucks. And, we want people to be successful, but we want this industry more than anything to be sustainable and affordable. And we want to be able to, help more than we're hurting. And a lot of the stuff that happened between 2012 and 2015, that whole set of syndicators that came in, they did probably more damage than good, maybe, caveats. And of course, any of my clients listening, I'm sorry, I like you and appreciate you, but we all went through a learning curve as this industry has been growing. And, we'd like to avoid that moving forward. So as a syndicator, you have the responsibility to really need to set some expectations. A lot of these parks really need improvements. They really do. They got some really old infrastructure. They got some really beat roads. They got some really ugly homes. And you're gonna have to pencil that into your capex. And you're gonna have to set the expectation that, hey, this year your cash on cash might only be X, but next year it's gonna be this, and then it's gonna grow to this, and then we're gonna have a waterfall, and you're gonna make up for the loss of cash on cash from year one that we're going to pay you out in year 3 once we go through a refinance after we built the books properly and got a good Fannie loan in place. Then we'll be able to kind of redo this thing, so you're whatever X multiplier you're looking for at the end, you're still hitting that number. We're just hitting it in a different way. But again, it takes a different approach, and I would really, if anything, I'm saying to anybody in this industry is, hey, I'm all about the money, but let's not do it on the backs of our poor tenants. There's other ways to do it.
Yeah. Very good. So thank you very much, Glenn, for all your insight. Right. How can our audience reach you?
Sure. So very easy guy to find. Just Google me. You can go to my website, The MHP Expert. That's the advisory side of my business. Or you can go to EstersonMHCteam.com. That's my brokerage side of the business. And, on there you'll see, $100 million worth of deals. And on the expert side, you'll see all the blogs. So both sides have contact information to me and anybody on my team. We talk to everybody. First timer guy with $200,000. Hey, I'm your guy. Happy to talk to you. You got $10 billion to spend. Hey, I'm your guy. I got time to talk to you. But we'll give everybody the time of day at first, and then, proof is in the pudding later on. And, hopefully we can form a strong relationship with, with your audience and myself. I'd love to do business with whoever I can, but I want to make sure it's being done ethically.
Okay, very good. And I think everyone can also go on to Amazon and order your book there, right?
Absolutely. It's just type in the Mobile Home Park Manifesto. Sounds like a dirty word. I promise it's not a dirty word. But it's the Mobile Home Park Manifesto. It's on Amazon. You can get the ebook for like $6 or $7. You can get the printed book for like $20. If you don't like it, I'll pay you back. Just tell me. It's here to be a real guide for you guys and maybe provide a little bit of a moral compass with this industry.
Yeah, very good. Thank you very much once again, Glenn. It was great having you on, and thanks for all your insight.
Absolutely, Anton. Thanks for having me on here. I really enjoyed speaking with you.
Same here.